Hello, dear viewer. Let me ask you a question. Have you ever come across a great deal from a seemingly trustworthy but unfamiliar supplier and decided to go through with it quickly, paying all the required taxes like an honest entrepreneur? Guilty. In this video, I want to talk about a bold and 100% illegal VAT fraud scheme. Why should this matter to you? Because whether you're a new entrepreneur or a seasoned business owner, you can easily become a victim, even while doing everything legally on your end. At first, it might seem like this topic has nothing to do with you. But by the end of this video, you might be unpleasantly surprised. Before we begin, a quick disclaimer. This is not a guide or instruction for committing fraud. Actions like these are criminal offenses. Even if everything looks nearly legal on the surface, this scheme is still fraud at its core. So, let's get started. Every year, billions of euros disappear from EU budgets due to one simple trick: VAT fraud. VAT, value-added tax, is charged at each stage of production and sale of goods or services. It's included in the final price for the buyer, but businesses can deduct the VAT they've paid to their suppliers from the VAT they owe to the state. Here's a simple example to explain how VAT works. You buy product X for 100 euros. Let's say 83 euros is the base price and 16.6 euros is VAT, 20%. The seller must transfer the 16.6 euros in VAT to the government at the end of the reporting period. If you're a business, you can, under certain conditions, claim a refund for the VAT you paid. If you're an individual, you cannot claim a refund and are the final taxpayer. In the EU, VAT is a major source of tax revenue, with different rates depending on the product category. But how exactly do criminals exploit this system and steal billions from government budgets? Let's take a look at one of the more complex versions. Carousel fraud, also known as missing trader intra-community fraud, or MTIC. Here's how the scheme typically works. Company A in Poland sells product Y to Company B in Germany for price X. Since it's a cross-border sale within the EU, the transaction is taxed at 0% VAT. Company B in Germany, upon receiving the goods, is supposed to pay VAT because VAT is applied at each point of purchase. However, VAT can be reported and deducted in the same tax return period, meaning Company B might not pay anything in cash at all. On paper, it's plus 20% VAT to pay, minus 20% VAT to deduct. Result: net zero. Then Company B sells the product to Company C, also in Germany, for a higher price, let's say 20 euros plus 20% included VAT. Now, Company B must pay the collected VAT to the German government, but it doesn't. Instead, it keeps the VAT and disappears. It repeats this scam multiple times, then vanishes. Company C, thinking it's a legitimate purchase, sells the goods to Company D and so on down the chain. Eventually, Company Z, the final buyer, requests a VAT refund from the government for the VAT it paid. The government refunds the money and realizes it's out of pocket. Someone in the chain didn't pay VAT, but who exactly? By the time the investigation begins, the scammers are long gone. Meanwhile, Company Z exports the product back to Poland, again with 0% VAT, since it's an intra-EU export, shifting the tax responsibility to the buyer in another country. Company Z legally receives payment for the goods, plus a legitimate VAT refund from the German state. And here's the kicker. The product might have never physically moved. It could have been sitting in a warehouse in Poland the entire time, sold and resold only on paper. That's carousel fraud. And now you know how legal-looking paperwork can hide massive criminal operations. Stay alert. Here's a real-world example. In 2024, the European Public Prosecutor's Office, EPO, uncovered a massive carousel VAT fraud operation codenamed Moby Dick, which involved Italian mafia groups. As a result of the investigation, 43 people were arrested, and assets worth over 520 million euros were frozen, including 129 bank accounts, 192 real estate properties, and 44 luxury items such as cars and yachts. More than 160 searches were conducted across 10-plus EU countries and beyond. The core of the scheme was the creation of fake companies to trade electronics, like laptops and headphones, in order to fraudulently claim VAT refunds using carousel techniques. The operation uncovered over 1.3 billion euros in total turnover from this scheme, with direct losses to EU and national budgets exceeding 520 million euros. Now, let's look at another fraud technique known as import via Procedure 42. This is a variation of the original VAT fraud example. Fraudulent company A imports goods into Poland, or any EU country, from a non-EU country such as China or Turkey. During the customs process, they declare the goods using code 4200, hence the term Procedure 42. Under this system, VAT is not paid at the border because the goods are supposedly destined for another EU country. For example, sold to German company B. Again, let me stress, Procedure 42 is entirely legal if you act in good faith and with legitimate business intentions. There's nothing illegal about deferring VAT payments when following the rules. But fraudsters twist this process. Instead of actually shipping the goods to Germany, they falsify the documents. The goods never leave Poland, or any EU country they were imported into, and remain in local warehouses. This tactic delays investigations and hides the fraud. Worse, some criminals don't even bother faking exports. They sell the goods directly on the local market, in this case to Polish company C, adding VAT to the invoice. Once they receive payment, they simply pocket the VAT they were supposed to remit to the government and vanish. And as you, dear viewer, now know, every legitimate company has the right to reclaim VAT paid on purchases. So Company C requests a VAT refund from the Polish tax authorities. In the end, the government issues a refund, money that was never actually paid into the system in the first place. By the time the authorities realize the imbalance, fraudulent Company A is long gone. And the budget? Left with a deficit. Let's take a look at two recent examples. In 2025, Olaf and the Polish authorities uncovered a scheme where goods were imported from China into Germany using Procedure 42, then secretly rerouted back to Poland and sold without paying any VAT. In another case, the European Public Prosecutor's Office, EPO, uncovered a criminal group in Germany that underreported the value of goods imported from China and exploited Procedure 42 to evade VAT, causing losses of over 200 million euros. Now you might say, okay, great video, but this has nothing to do with me. I'm an honest business person and I don't deal with shady stuff like this. Well, here comes the uncomfortable truth. It can affect you directly. Let's say you're a legitimate buyer at the end of such a supply chain. You legally claim back VAT on a purchase. Nothing shady, just standard practice. The government refunds you the VAT, and then the tax office starts investigating the whole supply chain. Eventually, they find that someone in the chain never paid their VAT and that the transaction was part of a fraudulent carousel scheme. Now what? Well, even if you acted in good faith, your company comes under suspicion. You won't be arrested immediately. There's still the presumption of innocence, but your business accounts might get partially or even fully frozen. And your VAT refund? You might not get it at all, or, at best, not anytime soon. Worse still, you'll likely be flagged for enhanced financial scrutiny by tax and government authorities. And during a years-long investigation, you might lose your ability to claim VAT refunds on other transactions, making your business much less competitive, purely because someone else scammed the system. Unfair? Yes. And that was my first reaction too when I learned how bad this could get for honest business owners. But under EU case law, there's a doctrine called should have known. This means you as a buyer are expected to carry out basic due diligence on your suppliers, even if you think you're just making a regular purchase. So what does reasonable due diligence actually look like? Here's a checklist of steps courts and tax authorities in the EU expect you to take. Verify the company in the National Business Registry of the seller's country. Check if the company is active. Is it being dissolved or already liquidated? Confirm their VAT registration and whether they're listed as VAT payers. Assess whether they conduct real business. Do they have working phone numbers, physical offices, or listings in professional directories? Inspect the supply documentation. If the goods magically appear in the EU without a clear origin, that's a big red flag. Analyze the deal conditions. Unrealistically low prices, shady delivery terms, or 3 middlemen with no economic justification. You should be suspicious. If you conduct these checks and keep records proving you did, the court will likely defend your position. But if you don't, here are some real-world examples. In 2023, a Danish court convicted a man for participating in a VAT fraud scheme involving car sales through fake companies. He was held liable for more than 22 million Danish kroner in unpaid VAT and was sentenced to prison and a hefty fine. The court ruled that he should have known the transactions were fraudulent. Also in 2023, a UK court ruled against YellowBirdBeats, a company involved in a VAT carousel scheme. The judge found that the director either knew or should have known the deals were fraudulent and denied the company the right to claim VAT deductions. I hope this video was useful and interesting for you. If so, don't forget to subscribe, and most importantly, share your opinion in the comments about this video's topic. Thanks for watching.